Okay, hello traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, February 28th. We just got the release of US fourth quarter GDP, guys, coming in at 2.6%. That tops the 2.2% estimate, which was recently lowered. If you noticed last night's report, the expectation was 2.4. So a beat any way you look at it. Okay, 2.6%. Previous read was 3.4. No downward revision to that one. Personal consumption slightly weaker than expected at 2.8% versus 3%. You'll obviously hear remarks harkened there with regards to the government shutdown and the impact that may have had. GDP price index a little bit stronger at 1.8%, and core PCE, the Fed's preferred gauge of inflation, the personal consumption expenditure, tops estimates 1.7% versus 1.6, which was the expectation and the previous read. So overall, I'd probably say pretty balanced. Okay, a little bit stronger on GDP, a little bit weaker on consumption, right in line to slightly higher on inflation. Guys, great to be with you this morning to close out the week. Jaya, Mark, Pooja, Steve, Ty, just wanted to get that out as that's hitting the wires right now. So broadly speaking, you'd think that'd be a little bit more of a near-term relief for the DXY. Here's what it looks like as we talk through this. But just keep in mind the levels that we're coming from. And certainly the expectation to last night's update and what I was noting is the expectation or the concern for a little bit of recovery in the DXY. We did register a new low in overnight trade. I told you guys 95.80. I think this thing bottomed out at 95.83. That was just basic slope, okay? And a convergence with former slope resistance off that high from December. Resistance, breach, acceleration, that level converged on just a basic 3-point touch support from last week. 2, 3, really nice level there. So look, I still think you're at risk for a little bit of recovery. I don't want to like chase the dollar lower from here. Broadly speaking, we are looking for the dollar breakdown, okay? Near term, immediately, again, we're right here at support. Can I have a photo of that last screen? Sure, Ty, which one? This one? Okay, let me zoom this out a little bit. I think you're talking about this reference point. So from December. Okay. And here's the dual screen for you. You got it. Just to put things in perspective. All right. So, a third reference point in momentum. Obviously, the data we're getting now, not necessarily dollar bearish, not crazy bullish either, but stronger than expected expectations for growth. Really keep the pressure on the Fed. If the whole question is not whether they're going to raise rates or not. I think the market has completely priced out any inclination of a rate hike. It's whether they're going to pause the unload of the balance sheet. And certainly in the last minutes and in the commentary you've been hearing from Powell over the last couple of days with the Humphrey Hawkins semi-annual testimony before Congress, a pretty steady, upbeat assessment while saying this is a good time to be patient. He must have said the word patient like 50 times. So, we can go over the fundamental quote unquote implications of this till the sun rises. At the end of the day, price is at near term support. The weekly chart, again, I just wanted to highlight we're at the 200-week moving average now. Okay, so it's the same sort of key major inflection point that was the bane of our existence ever since the high that we registered last year and the pull lower. We haven't been able to get below this. So look out below. It might be a near-term recovery here. Ultimately, I do want to see things hold and move lower. Kind of just as a point of reference, guys, for the weekly charts, when I see something like this, is the high week close that we just registered. I want to see that respected as resistance on any intra-week bounce. So that's 96, 97, 92 rather, excuse me. It's basically 97 handle. So this is what we want to see hold as resistance if this is indeed breaking lower. Near term into the close of the week, you're coming to that 200-week moving average. Again, the low week close, looking basically right at that 95.66 level. Daily chart, again, there it is. 95.66, also the 200-day moving average, and monthly open support comes in at 95.55. So if we do break lower, you know the targets to go. Right now, we have not gotten a daily close below the 618. You're heading into slope support. You're marking divergence. If we plow through, we got to adjust this slope, by the way, guys, from yesterday's levels. Ty, before you take that picture, well, we might want to just adjust this right to the new low that we registered in overnight trade. So it's a slight adjustment, but it's going to change the fib a little bit. And that puts the first 236 level right there at 96.20, and that's on with slope or parallel resistance. Okay, so if we break above this today, that's what would, in my mind, at least be the onset of a larger recovery. Ultimately, we're still looking to sell it. Bearish invalidation, unfortunately, again, still has to be up at 96.60. That's the objective weekly opening range high, converges on slope. It's the only thing that would put us bullish. Otherwise, if we crack through 96, I'd expect a bigger recovery, but you'd look for exhaustion at one of these two levels. Okay, ultimately we want to see that drop towards 95.64, 95.55. Again, that monthly open and 200-day moving average. Any questions on DXY? Again, I was really interested to see how that GDP was going to print, and it's interesting to see that we topped expectations with 2.6. Not bad. All right. So I didn't tell you what was on the menu today. Beyond that, we'll hit Euro after this. Kiwi, Aussie, Gold, Sterling, Dollar CAD, Crude, and SPX. If you have any other questions or trade setups, guys, feel free to throw them on the message board. Next up, here's what Euro looks like. So again, one of those trades where the weekly chart has us coming into has us eyeing at least resistance just a higher up. You see that trend line confluence just above 1460s at this point on the weekly chart. That's sort of your major resistance level you need to clear to get the upside going here in Euro. And 113 is still key support. Nothing changed here on the weekly chart. Daily chart looks like this. Okay, here's what we look like. Yeah, here's what we looked like last night. Here's the daily chart first. The 618 retracement of this recent decline from just last month's late high, okay, gives you 1407. We kind of probed through that just now. We're pulling back, obviously some dollar strength here. Very contentious break of that trigger. It's only a 2 point, so I don't want to stress it. But the point I want to show you here is that 1445 is really a big region, okay? 1450s, 1445. It even extends here on the weekly chart, like we just said, 1460s. This whole zone here is huge for the euro. So the daily chart, real quick, basic slope off the yearly highs, converges on this year's open. All objective stuff, right? Add to that, aside from it being the yearly open, it's also the monthly open. Monthly open resistance now comes in at 1446. You got the yearly open at 1445. You got slope resistance all converging right there. That's the major level of resistance for euro. Right now, initially, this is a preliminary level. Okay, we've had a pretty decent stretch. So again, it's one of those trades, just like dollar index. Wouldn't be too surprised to see some exhaustion. Here's the intraday chart we were looking at yesterday. We highlighted 1363 just as a near-term support target. It held into the overnight trade session. Here's the probe higher, 1407 triggered, really quick whip back right below. So again, this could be an exhaustion pullback. Here's momentum capping out right at 70. Wouldn't want to chase this to the upside necessarily from here. 1445, like I said, 1450 is still a huge region. So we'll have to see what this does into the U.S. trade session, guys. It's not necessarily a bearish signal. I don't want to fade it, but I don't have anything on the long side here for new, fresh exposure. If you're holding anything south of 1380, I just have a break-even stop and let that thing go to 1445 if you can get it at this point. If it breaks below this channel, we could test weekly open support as low as 113.34 again before we rebound. I wouldn't want to see anything lower than this if this initial stretch has legs. The whole point of this is I want to see 1445 at least as a test. It's such a huge region. Again, yearly, monthly open support, slope resistance, all loaded there. If this washes out below channel support, probably get the bigger correction lower first. At that point, we'd start to look for exhaustion possible entries again a little bit lower down. Same thing as on the DXY. We got to adjust that retracement that we were looking at last night to the new high we just registered on the back of this data. Again, that brings the 236, just a basic retracement in line with that slope. A little bit later here in the session, near 1375. Actually, at this point, guys, scratch that 236. Watch that high. I'd be looking at that as more an important level. Pivot, resistance break, support, gives you 1370. Now, you guys might have seen Jamie published a piece on our free side SB trade desk for the euro. Really loved it. I loved it. He showed it to me. I got so excited. Uh, so if you go to the homepage, that piece he recently published on the euro. I mean, this kind of symmetry and the stuff that we look for is really interesting when you see these things kind of manifest themselves. So we basically took the inverse or the mirror image of that low volatility period that we made into the 2014, 2015 highs. You know, it's almost an exact mirror image of what's happening price action now. Again, not something to just bet the farm on and go long, but certainly in line with what we're looking at with respect to the larger turn higher in euro this year. Okay, so I have been tracking this since late September. Jamie's analogs are great, right, Ty? They're awesome. I love them. So these things certainly, you don't want to use them as a carte blanche, like I said, but definitely further evidence on the assumption or the assertion that euro is coming to a pretty big level, very similar to what we saw here. Not necessarily going to be a drop like this accelerate to the upside per se, but certainly price action is prepped, is primed for such a scenario to pan out. So all things held constant, we're still a constructive euro. Like I said, heading into the close of the week here, heading into the close of the month. Don't forget, today's the last full day of February trade. As I always tell you guys, I am very cautious into the monthly closes, monthly opens. It's not my best time period. Maybe it's just me as a trader. Maybe that's my fault, but I just, intraday trends tend to get wicked, okay? Because there's a lot of portfolio rebalancing, a lot of people jimmering just for positioning into the close of the month, and it could wreak havoc on intraday price action. Add to that, that certainly we still have all this event risk on tap. Don't forget, we'll go over CAD. We still have CAD GDP data tomorrow, the quarterly print, even though they come out monthly. The smell of napalm in the air. Where's the match? I like that, Ty. Love the smell of napalm in the morning, right? All right, so euro dollar, look for an exhaustion pullback. If we get sub 1370, do watch out. You look for a larger correction at that point. We'll have to reassess where we'd find possible reentries, but all things held constant, coming into an interesting level of resistance. All right, that's number 2. Number 3 is Kiwi dollar. Okay, here's what Kiwi looked like last night. I reworked the slope here, and it's I often tell you guys to try to avoid doing this, but sometimes again we take what the market gives us. I'm not a big fan typically of kind of finessing the slope, as it were, but this one actually worked out pretty well with just a basic modified pitchfork. All we had to do is modify it from the low of January, the high of February, and the subsequent low. Median line, pretty decent pivots, right? The 50 line or the lower 25% line, whatever you want to call it, you saw a breach, acceleration, rebound, support, a little bit jimmering there, but breach, acceleration, and that's where we were sitting at support yesterday. So as I noted, if the breakdown is legit, and remember, why were we bearish on this last night? Objective stuff, right? What was the bullish invalidation level on the previous update? Our bullish invalidation level was the gap. Okay, if we had broken below the gap, if we fill the Friday gap or the Sunday open gap, which required a move to 68.43, a break below that level would be bearish. And not only would that be bearish, guys, that constituted a break of the objective weekly opening range. Here's your weekly open low. set a high, you retest the highs. Here's a break of the weekly opening range low, come back, test it as resistance, and it held as resistance all through Asia until the break lower. So last night we lowered our bearish invalidation level to 68.76 or 77, which was a 618 of that recent decline. We can mark that off at this point. We've broken that and made a new low. Near-term resistance now drops right back to that uncovered gap. Downside support targets unchanged. So you're looking for 68.13. Still looking for that on this drop. That's the 618 retracement of just this near-term range. Okay. Then it gets a little hairy below that, guys. I would have my last limit at 67.90. Okay. If you have anything left on it past here, I would take the majority of it here. If there's anything left on it past here, I would book the rest because, look, you might get the drop and extension into the parallel, which was perfect support here, but I don't want to get caught on the wrong side of this. So if it gets into this region, look to do something. If we sail through it, the 100 and 200-day moving average are almost right on point. You see this range right here, 67.54, 67.50. That's like if you extend a break below parallel. But for me right now, the only focus is just on a drop into this region. In fact, I'd be looking for possible exhaustion there. Maybe a re-entry on the long side if we get something like this. All things held constant right now, 68.13 is your focus on this Kiwi drop. Any questions on the New Zealand dollar? I put out a piece yesterday on Daily Effects. You might have seen it with the weekly chart for this piece, for this setup. A good thing to keep an eye on, guys, especially as we head into March trade, okay? The yearly opening range is still intact, and the yearly opening range is defined by the January opening range. So here's your January open. In that January stretch, you made a singular straight range. We've been in that range ever since. The longer the range holds, the coil, the more definitive the break. Don't take my word for it. Here's what happened last year. We went over this earlier in the week, I think, right? The start of January trade was very similar of 2018. We sat there for a good, all the way deep into April, okay, before we finally broke the lows for the year. That led to the opening range move. Could be a similar scenario here, okay? Ideally, we break higher for a test of 70.91, even 71. This is the big level for Kiwi. If we get the rally or extension higher, I only target something into this range. We'd want to see what happens here. But certainly the initial focus is on this 300 pip range between 66.30 and 69.30. Okay, so with that in mind, the broader picture, the daily chart shows even a near-term consolidation. I don't know why I don't have a yearly open here, but here's the yearly open. All right. So ever since the yearly open, you've been making a series of, ever since the lows, essentially, you've been making a series of higher low, higher low, higher low, lower high, right? Near-term consolidation. Focus right now is for the stretch to move lower, 68.13, and again, that lower parallel just below the 68 handle. Questions, comments, concerns on Kiwi? Okay, so no change to the levels that we made from last night. The only focus change here is, or actually no, this one's right on point. Everything's still on point. So just drop your near-term bullish inval now to the uncovered gap close that we were sitting at yesterday. That's 68.43. All right, number 4. Here's Aussie. So I guess this is the one I was trying to talk about earlier. I got confused. This one is the one where I tell you guys, I'm not typically a fan of finessing the pitchfork, but this looks functional to me, and I don't want to ignore it. It's not off a low, it's not off a major low. Like I said, sometimes these slopes are more of an art form as opposed to a science, but the 50 line was perfect resistance, or the 75% line. And yesterday, as I was writing this, the lower 25% line was right on the weekly open support, and that was 71.35. And the thing, again, our focus said if it's going to head lower, look for resistance ahead of 71.65, 71.71, 618 retracement. The median line was in there for the slope we just added, and the 100-day moving average. Well, look where we topped out in overnight trade, guys. This thing rallied, registered a high right at 71.65, okay, and then just collapsed. So we're heading into the major support region we were looking at. This is the zone. It's 70. It's really 7109 to 7115. But just look at this whole zone. Even a little bit lower is that slope. So very similar to what we're looking at with Kiwi. Whereas Kiwi was the more convincing of the two, because remember, Kiwi dollar as opposed to Aussie, or unlike Aussie, Kiwi dollar actually broke its weekly opening range with this move yesterday, whereas Aussie was basically just like kind of sitting on it. So, long story short, we're looking for a stretch lower into the 71 handle, 71.15. Look for a reaction there in Aussie. And again, if that gives out, kind of be concerned for a bigger Aussie move lower towards that 70.80 handle. That's the low reversal close that we made on the 21st. Here's Aussie on the daily chart, or on the weekly rather. Very similar. Well, the range is much larger, so I wouldn't want to say similar, but you're still looking at a very critical range here for Aussie, just below slope resistance. So you're sitting flat in the middle here. It's not a time to get super aggressive on either side of the trade. Again, ideal scenario, this thing drops into here and we see some sort of reaction. If you see exhaustion, might be an area which you could find a little bit more of a support. One thing I do want to look for, just bear with me real quick. I want to see what this extension looks like. Something like this. Possible to get a deeper move here, but watch 71. Watch 71. Don't get hung up over a couple of pips. I'm still looking for possible exhaustion here. Again, weekly opening range giving out. It's Thursday. It's the last day of the month, though. Really important for us to take note of that. So heading into the close, just be careful. I'd be looking for exhaustion into 71. Quick side note, guys, also for those of you in the room, I'm flying out later tonight, so I don't think I'll have an update for you before the end of the week. So feel free to ask your questions here on anything you want to see before the weekend. And I will be flying back on Sunday, so the next update on the intraday page will be on Monday night. All right, that's Aussie. Before I move into, well, let's go over sterling and CAD first, and then we'll jump into the commodity blocks. So sterling. The last update on sterling was right here as we were heading into that December low. Now, remember yesterday we were in the webinar as this thing was testing 133. It was trading above 133, and I told you guys I think this looks like exhaustion. Interestingly enough, despite the rip higher that you saw in the euro, sterling didn't really participate. Okay, and it's kind of been holding that level pretty well. Okay, and over in the U.S. trade session yesterday, you did spike pretty high. You got as high as 33.50, but you settled the day pretty much right at 33. I'm still thinking the same thing here, guys. You're getting divergence on the daily chart as you made that fresh high into U.S. trade yesterday. I don't want to get aggressive on the way down, but I'm just thinking that this thing is a little stretched here still. So as far as the levels are concerned, there's really no change. We're basically straddling this mark right here. That seems to me, I discount that as a false break of the upslope. So even just a test of the slope support or the median line looks for that low that we made here on the 27th. So that's like basically like 32.30s or so is where you want to look for support on sterling, or look for a reaction. If we get below that, look for a bigger decline. But similar thing to euro, guys. The upside is a little tired. You don't want to chase it from here. Here's the daily chart. Again, it's a beauty when you see these things manifest like this. Here's what the daily chart looked like earlier in the week. Here's the 25th on the sterling, right? Here it is, December low, 33. It converges right on slope. Look where this thing just hit, right? Bring it to a close, clear things up. Looks to me like we just ran into resistance and it held. So again, you're not bearish, but you're hitting upslope resistance, right? So sure, let's get a little bit of a kickback. Let's get an opportunity to get back in. There's not really much to do here. If you're really aggressive and you're looking to the U.S. trade session, you're itching for a move here on sterling. Well, first of all, if you have that problem, you probably should not be trading at that time. But let's say you really wanted to get into this. Again, the focus is just for a move towards the parallel here. Look for a reaction there. You know, the next upside target is 33.63. We just missed it on this stretch. That level is just defined by a former swing high back here in July of last year. Decent pivot, but nothing major. Beyond that, you're looking for like 34.50s, and then the big level is 35. So as it stands, I'm just concerned that you get a little bit more of a kickback here. I'd be looking for entries. If we get near 31.80s again, that major pivot that we broke through earlier in the week might be a better region to try to look for reentry. But it's a little tired here. It's a little tired. It's hard to justify anything new on the long side. So a little bit more of a wait and see here on sterling as well. Questions on the British pound. Number 5. All right, last but not least, of the majors, Looney. Right, so here's what dollar CAD looked like. We talked about this yesterday in the webinar as well. I don't want to beat a dead horse. 30.50 is the big level of support that we were looking for. We didn't get to drop into it. Remember the weekly chart highlighting the 200, the 52-week moving averages, the 38.2 retracement, all lined up right there along slope support. Daily chart also highlighted a pitchfork that we've been following from last year's low, a parallel, caught the lows back in September, caught the lows back in February into the start of, or the close of January, start of February. Here it is again, 200-day moving average right there. Intraday chart looked like this. And again, monthly open support was 31.22, 200-day moving average right here at 31.50. Did we get the drop? No, we didn't. This thing is stubborn. It can't seem to make it through that support. If you remember yesterday, guys, I left this exactly the way we went over it in the webinar just to show you. I remember who was asking in here about playing the long side here, and we added this quick channel. We said, look, an easy way to play the long side of dollar CAD is just to get really granular in near-term price. This is the weekly opening range. You're heading towards the weekly opening range lows. If it breaks this near-term channel, look to play the recovery higher. In that scenario, you're only looking to play near the range highs, if not slope resistance, which is what we're checking right now at the 132 handle. So this is just a near-term channel turned at the weekly opening range lows, turned at the monthly open support. Topside breach of that channel we added yesterday. You wouldn't sit in it all night. It would have been a hard trade to kind of swallow all night doing nothing. But here's the final extension. Look for exhaustion here at 32 if this is going to hold. Dollar CAD, guys, is just one of those trades where the last few weeks have just been a roller coaster. It hasn't been the trend trade that you want to just sit in and kind of forget. It's been a trade that you want to actively manage. It's been a trade that's been giving you opportunities on the shorts and the longs. But until we clear A, the monthly opening range, and B, just the initial weekly opening range, which last week we kind of sat in. This week we're still in. Don't target anything outside that zone. So play the inside all you want. But here we are checking near-term channel resistance on dollar CAD. So let me just zoom out a little bit. Here's the 120 minute. Okay, so let's clean this up. Near-term support. Whoop. Now back here, 200-day moving average. Let's drop that channel. There we go. Okay. And on a breach, let me just make sure that 100 is still in the right spot. And the 200 is a bit higher at this point. There. Okay. You can also look at this in the confines of, I mean, it depends how, granular you want to get, but if you get like 60-minute, again, we'll get a little closer. Could be sort of just a near-term consolidation trade. So I'll draw this in a different color, something like that, something like that. You'd probably work with that slope. So look for a consolidation break here to give you the tell. Again, continuation patterns typically. So the downside break would open up 30.50, which is that big zone on the weekly chart, on the daily chart, on every chart that we're looking for dollar CAD. We've been trying to get dollar CAD to drop into this zone for a while. Again, here's the attempt that we made in February, right into this start. Just missed. Here's the turn. So again, that's still the big area of support, but look for a break of this near-term consolidation. If we break higher, okay, 3250 is on the cards, even 3280. I wouldn't be too surprised, but it's a big support zone. It's a big support zone. We really do need to find some stability, some traction with a break below weekly open support to get this thing going. Okay, trend resistance, former slope resistance, current slope resistance, or channel resistance up here. You see where this comes in? Just above the 100. Like 3260, just above that 100-day moving average. So that's the, if we break out, that's the risk for this thing to, if it rips higher. So that is dollar CAD. Any questions on Loonie at this point? Still have some data, like I said, for Canada on tap tomorrow. Industrial production figures came out a little bit weaker than expected today. So maybe further fueling some of this CAD weakness, dollar strength on the back of that GDP number. But the big print will be tomorrow for Canada with that GDP number. Current account balance this morning was pretty bad on Canada as well. Data hasn't been all that good, so it's going to take something here for the dollar to break lower. I know there's a lot of lines on this chart, guys, but it's all about this zone. Okay, that is Loonie. And that's the majors or the FX crosses I've been covering. Let me know if you have any other questions on the FX crosses before we jump into some of the commodity trades we've been following, namely crude and gold. And then we'll take a quick look at SPX to close things out. Here's gold. So our last gold updates was a couple days ago, right here. And we were talking about this near-term consolidation in prices within the confines of the weekly opening range, mind you. Now, remember that our base case scenario, guys, ever since this move right here, we've been looking for a steeper correction in gold. I'm still thinking that's the mindset we go with. We had a bearish bias below the weekly open, below the weekly opening range high, rather. This consolidation did break to the downside. Okay, where did we find support? Right here. We dropped right into this lower parallel. We found support, rebounded an overnight trade. I wanted to see resistance right along that slope, but we did probe through it briefly before coming back. Still think the risk is for a deeper drop, guys. 1311, 1303, those are levels of interest for possible exhaustion, re-entry for the long side of the trade. The stretch that we've made has just been phenomenal. Momentum has been marking overbought, and not only overbought, divergence for the last 3.5, 4 weeks. Okay, higher high, higher high, higher high, a series of lower highs, all above 70. So a weak signal, but it still begs the correctionary move here before continuation. So look, we got the downside break. It made an extension. Once we knew that was a more assertive high and we broke lower, it made an exact 618 into that low. Okay, and then we rebounded just through that parallel before pulling back. Here's what it looks like now. You still, whoop, you still could get some more sideways action, but the point being is, for me, I want to see a deeper cut into a new low to fade if I want to get back on the longer term position here for gold rather. So here's the drop, a 618 again, 1, 2, 3, takes you right here. There's that slope support off the low from January. Boom, support. Here's the bounce. So, like whatever, maybe it got a little bit higher and rejected. What I do like is the fact of where it was rejected. Here is your weekly open resistance. It's actually right on cue. Okay, we turned just pips ahead of it. 1327 is the weekly open. Yep, that's it. So we turned just pips ahead of it. So look, make another stab at the high? Sure. For me, the only thing, like I said, that would turn me back on the constructive for the immediate standpoint would be assertive move back above the weekly opening range high. That would be objectively bullish. That's not Mike Boutros' opinion or Jamie's opinion. That's just price. Ideal scenario, you fail somewhere around this zone and then you get back to 1311 or 1307, and these on the near term front, big levels. I would love both as targets on the shorts and possible, exhaustion entries on the longs. Remember, here's the bigger picture for gold. Boom. It's been quite a stretch, guys. It's been quite the stretch. So you all know exactly where I am on the gold trade. I love it. We've been loving it. It's hard to get long from here. And if you're trying to short it, I'm not too opposed to playing the pullback. Just know that, a weekly opening range high break, in my humble opinion, you don't want to fight this. This is an uptrend that's, in stretch mode, right? In stretch mode. So if we get through the opening range highs for the week, I definitely don't want any part of it. Other than that, I'm kind of banking on seeing exhaustion somewhere here to see that last final move stretch near 1311, 1307 in gold. And it would bode well with, a little bit of recovery in the dollar, right? Kind of all the pictures, all the puzzle pieces fit. Any questions on gold? Crude oil. Crude oil, my friends, looks like it wants to make a move towards major resistance. Here's crude oil back on the 25th. We had highlighted this near-term downslope. It was coming right into support. Interestingly enough, that basically held, okay? We made another stab at the lows, but that did hold on divergence with the reversal higher, basically taking you right into the high day close, which was our near-term bearish inval. So for me at this point, guys, I really, number 4, Ty says, did I miss Aussie? Yeah, Ty, we went over Aussie earlier in the session. Let me know if you have any specific questions on it. I'll go back to it for you. But crude, here, let me take it back. Here's the daily chart. Well, here's the weekly chart, okay? I just wanted to highlight this slope. It looks different on the daily from the weekly, obviously, because the time aspect completely alters the slope of it, but just want to show you what this looks like. A weekly close above this slope is going to would have us looking at the major key resistance level we've been talking about since the start of the year. Now, at the start of the year, it actually converged on slope here, which made it a lot more appealing to me. But at this point, if we break that slope, it's still the level to look at. It's last year's open. It's the 50% of the entire 2018, trading range. And it's the upslope or the upper parallel of that pitchfork we were following until the 2017 breakout. Again, acceleration on the 2018 breakdown. All converge right here. This is your major sort of ceiling you need to get through first. Okay, it's the weekly chart. Daily chart looks like this. Again, a little bit slightly different on the slope, but here we are again. This is the 75% line, okay? And we talked about this, how the 75% line caught the lows in the drop here in December. So again, some really nice symmetry. right here. We broke through it as resistance. We just rebounded off it as support. The upper parallel is just higher. Okay. So the game plan for crude was, look, this breakdown was coming in support. If we cleared this region, the game plan was to look for a deeper cut, possible reentry down here. Now that we've rebounded into this region, again, I can't do anything here. This is a near-term range. Here's the intraday chart. If this slope breakout is legit, you need to see this thing mount the high day close today. Okay. We had a really, really precarious slope. We only had a 2-point touch, so we had no idea if it was legit. The breakout looks like we tested former slope or former channel resistance as support. Here's the rebound. The high day close holds today. I still think you get that drop lower. 54.50, 53.80s entry for a long position. If we push through and we actually resolve the day above 57.14, you know, there's a very high probability this thing pushes through resistance. So precarious here. Again, my base case scenario is that crude does hold at least on the near-term front below 58.10. At this point, you'd need to let price action pan out. It's the last day of the month, heading into the start of March trade. If you spike, like let's say into tomorrow or into early Sunday, we spike into 58.10 and then we resolve that day on a lower close, that might be the entry for the short. But heading to the close of the month here, I wouldn't be surprised if this thing just whips out everyone. All right, last but not least, SPX. This one we've been following for the last couple of weeks. Here's the slope. I just wanted to highlight that slope failed yesterday, just pips ahead of that 100% extension at 27.73. The risk is still the same. The risk is still the same. Now that we've made this reversal here, okay, and yesterday's up, up reversal candle basically. If we get another spike in 28.10, it wouldn't be outside the realm of possibility. It wouldn't be outside the foul for resistance, but you're still at risk. You're still at risk. You've been marking divergence all up into that channel resistance. This thing looks pitiful as a pullback, but even if we do spike higher, again, like below 28.10, below 28.07, I still think the risk is for a deeper cut. We're looking for a 27.73 target. Ideal scenario, a deeper cut towards 27.50. But it is what it is. We have to follow what price is giving us. This is kind of the formation I was looking at earlier today as a possible scenario breakout here. Right? So again, if we were to break back above basically the weekly opening range highs, you'd leave in this another extension 28.10, but you're still below resistance. If this holds and we break lower, the lower parallel converges, basically in that zone just above 27.55. So it all depends. If this consolidation breaks higher, again, don't do anything here. I wouldn't want to be the wise guy. But if it spikes and you see sort of an exhaustion candle, a long wicked candle, a reversal candle, something, that might be an opportunity to take another short for the move lower. But you're certainly, very precarious, hairy situation heading into the close of the month. So guys, I do just want to really highlight again, these end of month flows tend to wreak havoc. I'm going to pretty much end up closing the month out flat. As we open up March trade and specifically heading into a weekend, just not the best time to really press something aggressive. So keep that in mind. Another side note, I will be speaking at the New York Traders Expo on March 11th in New York. If you guys are going to be in the area, would love for you to come out and see us. Daily FX will be doing some presentations there, and I'll be presenting on confluence regions of resistance and support. It's a really good event, guys. A lot of the bigger guys in the industry, a lot of my friends, Todd Gordon, Ashraf Lighty, will be there as well. So good time if you're around. Again, a quick reminder, I will be out tonight and Sunday. So the next intraday update will be on Monday night. That's all I got. If no other questions, we'll go ahead and wrap it up here, guys. Best of luck trading. It's the close of the weekend. Stay cautious and stay nimble into the close of the month. And hopefully March trade promises to be very interesting with where we're trading at on some of these majors. Best of luck trading. Have a great weekend, and I will see you on Tuesday. No scalp webinar on Daily FX on Monday. We're going to come right back here on SB on Tuesday morning. Cheers.